Great to have you. I want to start off by talking some equities, and then I want to talk about your gold article you wrote yesterday as well. But firstly, for equities, what are you looking at right now? What's going to tell you kind of when we're either in the clear or if things get worse from here?
That's a great question. The thing I'm watching is President Trump's Twitter stream.
Okay. Is that the be-all, end-all at this point?
It most certainly is. I think what we saw yesterday was the fact that China realizes that the U.S. has a soft underbelly, and it went ahead and punched us and it punched the market, which is what President Trump uses to sort of evaluate his success, and sent it down almost 1,000 points. They came back and eased a little bit overnight, and then in a knee-jerk reflex, stocks surged higher overnight, and they look to open up higher today. You're seeing all the talk, as Kevin was referencing, that earnings are pretty good and they're constructive, but I think we're in one of these sort of unprecedented times when sentiment will drive the market much more so than earnings.
I love this point, Steve, because to me, you never really know what the sort of called a transmission mechanism will be for, price discovery in markets. But when you've got multiple expansion from 15.5 in December to 20 times trailing at the high, while earnings expectations going forward have dropped, to me, that becomes a more fragile market, right? It would make sense that sentiment drives things a little bit more.
Look, I think so. And what you say reminds me of that old saying that there are no atheists in a foxhole. So everybody's very aware of valuations. And I think over the weekend, even on Sunday, David Kostin of Goldman Sachs came out and said that he thought the market was fairly valued at 17 times earnings. Mm-hmm. Now, if that was true and things went on sale yesterday, people would have rushed in to buy. But in fact, they did the exact opposite, and they headed for the exits. There are a few things that the market can do really well. It can do earnings, discounted cash flow, and all this sort of jazz. But what it can't do well is analyze politics. And until there becomes some clarity in the trade war and what China's going to do versus what Trump is going to do, I think we're going to see this volatile environment, and you're going to see the VIX as the primary proxy of that whip around.
Now, to the VIX point, yesterday we saw a real quick spike up. Is there any time frame that to you makes the most sense as an analog for this? I mean, I don't think there's a great analog for tariffs and each weapon being brought out from each side of the two world's biggest economies, but we also had a devaluation in 15 that caused a VIX spike. We also had a moment of economic concern at the end of last year that spiraled into a major sell-off. Do you see any good parallels?
Well, the biggest driver of VIX, I believe, is the fact that it was low relative to everything else being high. If you recall back in, I think in Feb of 17, when it went up 115% in one day, and SPX went down 4%, ever since then, a lot of people have backed away from the VIX. They've had a lot of concerns about the market's structure and integrity. In the past 3 to 4 months, though, on the institutional side, you've seen things change a little bit. I think that reflects some of the efforts the CBOE has done to educate people. But it gets back to your point, people just view VIX when it gets to be this low and the risks get to be so high at a macro level that they simply buy it. And then they're waiting for some type of a big exogenous shock to pay off. And it's not that expensive to buy, but if something happens like yesterday, then you make your money. And look, in last week, not to get too terribly granular, the VIX curve was flat. So all the people who've been buying VIX options or VIX futures look to have made losing bets. And then you got the Sunday night massacre out of China.
Yeah. So I want to come back to that point because I think it's an astute one. VIX had kind of carved out a new floor, I would say, ever since Jan 18. And whether it's valuations, if it's tariffs, or whatever was kind of the cause for the sell-off, as we were talking about here, when we started getting down to low 12s, it just seemed like, look, we don't really stay down here for long. So are we seeing the kind of trend emerge where there's opportunities to buy volatility at that point?
I think so. I think people are more comfortable doing that now than at any other time since over the past year or so. Why? Because look at all of the things that we're discussing and that you discussed previously with the guys. The risks are high. The people can't handle the trade war. Everybody in the institutional community knows, and I think this is increasingly true in the retail community, that VIX options are like SPX puts on steroids. And when they're cheap and VIX is far below spot VIX, the non-tradable VIX, is below the long-term average of 19, people want to gain exposure to that phenomenon. And what happens mathematically with the VIX is the VIX is low not because it's not at 12 because the index markets think that there's no risk in the world. It's at 12 because the stock market's been grinding higher.
Yeah.
So realized volatility drags it down. So the more astute investors try to take advantage of that, and they try to take that low spot VIX reading, analyze the shape of the VIX futures curve, which determines the price of the VIX options. It's kind of complicated. And then they make these bets, and sometimes you get lucky. I'm not going to say that yesterday was lucky for anybody, but it certainly did pay off for the VIX guys.
Yeah. Do you see a particular opportunity that exists now after this sharp move to the upside in VIX, where you had basically it took like a day to invert the curve, right? I mean, backwardation like in a heartbeat.
So I think for most people don't realize that VIX options prices are based off VIX futures prices, and that the VIX that everyone talks about can't be traded. So what I'm hearing from a lot of active traders, high net worth traders, and even institutions is they're taking advantage of these short-term paroxysms of fear, and they're doing things like selling cash secured puts. They're buying favorite stocks on dips. They're continuing to engage in call ladders, which is to say, I have a concentrated position in stock XYZ, and I'm always going to write calls against it that are 5 points, 6 points, 7 points above, and if I get called away, so be it. But if I don't get called away, I collect the premium. Those are the types of things you're talking about with interest rates being so low and bond yields being so low. What did great yesterday? Verizon. There are a lot of equity that people are parking cash in that pay far more than bonds, and those are all the things that I continue to see.
Steve, you had an article on how to play gold in Barron's yesterday. I want to go there before we let you go because I thought this was pretty interesting. Give me your take on how to use options with this rally. I mean, it's just kept on going. The chart is like a perfect higher highs, higher lows. What's the best way you see to play this move?
Probably with call spreads on GLD. You establish a sort of a trading range. You're long a call that is either at the money or slightly out of the money, and then you look for something a little bit higher above the market to offset the price. If we first mentioned this to our readers back in June, I'd been in Namibia, of all places, earlier that month. I was sitting around a campfire, and all the guys were talking about how the world seemed to be entering this Mad Max phase, and they were buying gold. And when I got back to the States, I looked at gold. We caught a great trade on it, and it paid off big yesterday. But you know what? People are afraid. They're going into Bitcoin and they're going back into gold. And if you're going to look at it, Bitcoin is whatever it is, but you're going to find that spread trading is going to be very popular for these safety assets that are trading at record highs.